Morning, everyone. Let's kick off. Welcome to Saxo's Monday morning calls with VIP clients for a market update. I'm Charu Chana. I'm the APAC Strats based in Singapore, and I will kick off now with the big picture. So we've had a slew of risk negative events to end last week, especially, of course, the US CPI, which is making the most headlines. It's come above expectations once again. And I think the key here is that, what we've been telling clients earlier, that we don't believe in the peak inflation narrative. We believe in higher for longer. And that's exactly what's playing out right now in the markets. Sentiment also among Americans collapsed to an all-time low, as has been seen from the University of Michigan update, and inflation expectations have surged significantly. And lastly, of course, the risk negative event coming from China, with Shanghai returning to a lockdown for mass testing just days after returning from a 2-month shutdown. My colleague Redmond will probably share more on that later on. So what has that meant? It has meant another round of coordinated sell-off in equities and bonds last week. The S&P and Nasdaq both are down 2% last week, which is the worst weekly loss since January 2021. And both the indices are now below key support levels, S&P below 4,000 and Nasdaq below 12,000. Also, 10-year yields are now at 3.15%. This morning, we've seen the futures opening down hard as well, which kind of signals that this week is primed for a ton of risk-averse behavior. What does that mean? And the one common question that we repeatedly get from clients about, are stocks cheap now? Is it time to enter the markets? So just on that, it's worth noting that S&P valuation is now reaching its long-term average, but it is still not below the average. So we at Saxo still think that there is more potential for a slide in equities as macro risks remain significantly high. I'll now turn to a macro update with 3 key events. First, of course, again, this US CPI, which was 8.6% year on year for May, coming in above expectations and a fresh 40-year high again. Core CPI at 6% YOY, and the largest contributions were from shelter, airline fares, used cars, new vehicles. Of course, and that's the core, but we've obviously seen the usual food and energy being big contributors as well, and services inflation. Let's not forget that. That's where most of the inflation is shifting to now. So what has that meant is that rate hike expectations are soaring to their highest during this cycle. The market is now expecting Fed rates at 3% by the end of the year. The odds of a third 50 basis points rate hike for the September meeting are now at 100%. Remember, just 2 weeks back, we were talking about, or in fact, some of the Fed speakers, especially Bostic, was talking about, there could be a potential pause in September, but now we are actually pricing in a 50 basis points rate hike there. So that's quite a switch in the markets. Not just that, actually, we are starting to see calls for a 75 basis points rate hike this week. Especially Barclays is now saying, 75 basis points on June 15 rather than their previous call for a 50 basis points. And that's highly likely. We can easily brace for more losses in equities. The other macro event of note is the ECB meeting we had last week, which provided some level of certainty for the near-term rate hike path, with a 25 basis points cemented for July. However, beyond this immediate hike, the move for September is still a call between 25 or 50, and it will depend on how the inflation pans out. For forecasts, the Eurozone inflation forecasts have been upgraded for 2022, 23, 24, all remaining above 2%, which is actually the target that the ECB has. But I think the bigger takeaway from the ECB meeting was the lack of a fragmentation tool. Why that's important is because it is needed to protect the bond spread between Italy and Germany. And unless we see that, really, at least at the July meeting, the expectations for ECB tightening will continue to remain capped. So that's important. Also, I think we are seeing a lot of pickup in ECB tightening expectations. Deutsche Bank actually is now expecting 250 basis points rate hikes from the ECB, as against one rate hike last week. And switching over to the last update on the macro side will be the Bank of Japan meeting. We have the decision due this Friday, and the risk of a BOJ tweak to its yield curve control policy is increasing. We have the USD yen now in close sight of 135, looking to move above the key 135 resistance soon. And if the Fed does go for a 75 basis points on Wednesday, we could see it getting closer to 140 as well. There was a three-party meeting between Japan's Ministry of Finance, BOJ, and the Financial Services Agency on Friday, which expressed extreme concern about the rapid decline in yen against the USD. Again, also kind of hinting that a response is well due. But despite that verbal warning, the yen has continued to slide. I think my sense is that a real action, there is substantial scope for that. Intervention isn't going to be the actual solution for this, and we may see the BOJ starting to build a case for some tweaks to its policy. In the FX space, dollars back at cycle highs, and we've talked about, USD yen is now closer to 24-year highs. The euro is also now back below 1.05, which is, of course, despite the hawkish ECB last week. And the threat is now seen at the next support of 1.035. Not to say that the euro won't gain with the ECB turning hawkish, but it's a game of relativity. And this week, it may be tough for any currency to make any substantial progress against the USD, really. Aussie dollar also broke local support on Friday, and USD CAD, the Canadian dollar, is also reversing harder after the release of Bank of Canada's financial statement review on Friday. Over in the commodity side, things are looking slightly better in terms of investments. Commodity sector is showing little sign of global growth worries. So we had last week the Bloomberg Commodity Spot Index also reaching a fresh high again. It's now up 38% so far this year, with most of the gains being driven by a surge in crude oil, gas, and fuel prices. The WTI was above 123 on Friday, although we are seeing some pressure this morning. Copper is also showing some concern on the economic momentum, but more so from really Shanghai entering another lockdown. But we've seen gains come back to gold. It is nearing a 1-month high despite a strong USD, and that's mainly because actually rate cuts are starting to get priced in for next year, which signals broader fears of a recession in the markets. But we do believe gold has, at least on a relative basis, it's been doing well, and especially for non-dollar based investors, we are still bullish on gold because of the rising risk of a central bank policy mistake as well. On that sour note, I think I would hand over to my colleague Redmond, who will talk us through his views on the markets and especially dig into more details about China and Hong Kong.
Hi, good morning, everyone. As Charu just mentioned, I mean, of course, it's the focus really is on the U.S., the very much larger than expected CPI number from the U.S. last week. And just to add a little bit to it is, I think now the money market curve price in a total 165 basis point rate high in the next 3 FOMC, that you translate to about 80% chance that's actually on a 75 this week. So that's much higher than, I mean, before the number, I think it's only at 145 basis point expectation, 145 basis point for the next 3 meetings. So that was a big jump there. And also the curve, and just want to bring that also up, is the US yield curve actually, I mean, on Friday, actually the 2-year up or almost 30 basis point, 29 basis point actually, and the 5-year up 23. So actually, if you look at the yield curve 5 to 10 and 5 to 30 already become inverted, because it's 5 at the 30 year actually moved very little, just 2 basis points on Friday, and the 10-year up only 13 basis points. So what it means basically is the market repriced much higher, as Charles mentioned, is a bigger rate hike, more rate hike near term, and a higher recession risk down the road. So the curve actually 510 and 530 already inverted. Yeah, but the 210 not yet. And another thing is from Friday, of course, worth to note is about inflation. So from the U of Michigan, the long-term inflation expectation element in that survey actually jumped 0.3 percentage point to 3.3%, and that is the 5 to 10 year consumer inflation expectation. And remember, Fed actually has been mentioning in the past that we will because the long-term inflation expectation was is anchor. I mean, but so they did not. They can actually wait. But now there seems the DCAT survey showing that the long-term inflation expectation, at least from the survey, has been running away, and that may actually contribute to the Fed decision, maybe to a little bit more aggressive. And having said that, of course, the five-year break-even actually is actually has come down. So the market actually is looking at the inflation will be lower 5 years later. So so all the inflation is in the next 5 years. So it's, once again, they expected the Fed will be very hawkish, and then there would be a slowdown or recession later on. That is what the market information is saying. And back to this part of the world, and I mean, China and the Chinese market has been doing well last week and before the US number. And MSCI China actually rally 6.3%, and CSI 300 up 3.7%, Hang Seng up 3.4%. And the rise is led by the Chinese internet stocks, and Hang Seng Tech Index up 9.7%. And the northbound investment from foreign investors into China actually become a net buying of 5.5 billion US dollar equivalent last week. That was actually the highest weekly northbound net buying this year. And all this the better sentiment towards Chinese stocks, Chinese equity was helped by just to summarize, and the Wall Street Journal reports last week the Chinese authority were about to conclude the cybersecurity investigation on Didi and two other e-platform companies. And also China approved the second batch of license for online game for 60 online games, less than 2 months since they did it in April. And also, the U.S. is considering, I mean, rolling back some of the tariff on goods from China, and this have been helping and then improving the sentiment. And also on the data front, last week we saw the export and credit numbers were better than expected. Exports in May in China grow 16.9% in US dollar term. And those industries, exports from those industries like autos and tech and so on, those were very severely affected in April. In May, they saw material improvement. And also on Friday, we have the credit data. The aggregate financing in China in May rose to renminbi 2.79 billion, and in April it's only 0.9 billion. And that's the new aggregate financing, the support measure of the Chinese liquidity. The outstanding aggregate financing number on a year-on-year basis grow 10.5%. That improved from April's 10.2%. Actually, this year's and over the last few months, this year's the number has been fluctuating between 10.2 and 10.5 on a year-on-year basis. So there's some improvement. But if you look at the more detail, I mean, it's that the detail were not as strong as the headline suggests, and because it's the rise in the aggregate financing was pretty much mainly due to new government bond issuance and short-term corporate borrowing. Medium to long-term corporate loans and medium to long-term household loan, i.e. most of them are mortgages, actually rather weak. And then is the CPI. We also have a CPI number last week. It came at 2.1% year-on-year in China in May, and unchanged from April. And CPI stay rather benign versus what's happening outside. I think it's helped by a still big decline in pork prices in China this year, and still down I mean, still down 21% below last year's level. I mean, pork carry about a weight of 4.8% in China CPI. And then in May, also some of the moderation due to the normalization or deceleration in increase in vegetables price. PPI, and in China in May, PPI came at 6.4%. That was lower from 8% in April. That was mainly because of a very high base effect last year around this time in upstream material prices. And on a month-on-month basis, actually CPI in China actually declined in May, and then PPI in May is if you do it seasonally adjusted, an annualized rate is 2.4% in May, but that is actually much lower than the April's 9.8% on a month-on-month annualized rate. That gives you some ideas that is inflation in China decelerated a little bit in May and still under control, is different from outside. And so that gives some room for the Chinese authority to ease monetary policy. But I mean, but having said that, I mean, it's because of the Chinese government does not really want, I have this very concern about any popping up of another bubble again. So they will be very cautious. And also, given the external environment with the Fed, the ECB, everyone else is raising interest rates. And even though inflation in China are benign, and I think that they will be very prudent and will be very measured and very slow in easing monetary policies. And this week, I think, and the worry is we have discussed already about it. The rate hike probably coming in the U.S. and this. Not probably, but it's almost for sure. And that will also pressure the sentiment in the Chinese stock and also in other Asian equity market as well. And also, as Charles mentioned, I think investor has now become more concerned again and about the likelihood of introduction of tighter lockdown measures in not only in Shanghai and also maybe Beijing or in more cities, because it's in April, I mean, there were more than 40 cities under lockdown, and then in May the number has come down to 15, 16 cities. I think 16 cities, and so and also is the major city like Shanghai has been reopened. So and now with some emergence of some cases, like Shanghai reported 37 new local cases, and 5 of them are outside quarantine. And Beijing reports 51 new local cases and yesterday, and also Beijing government say it's hard to control the spread of a recent bar cluster infection. And in fact, I think now this is already 166 cases related to this bar cluster. And last but not least, and last week, very importantly, President Xi during a trip to Sichuan, and he remarks that China adheres unwaveringly to the zero COVID policy. So with no change in the zero COVID policy, with emergence of some cases and in Beijing and Shanghai, and so I think that is going to cloud the equity market, and so that would be these two things will be the key thing to watch. For on the data front, and in China, this we have retail sales. We have actually quite a lot of number, but the focus will be on retail sales, industrial production, and fixed asset investment. And retail sales, the consensus is expecting for a decline of 7.1% year on year, and improve from last month 11.1%. And as we discussed and earlier, I mean, there's relaxation in the COVID policy, so retail sales will pick up, but very gradually, because most of the relaxation happened in the second half of May, and so the impact will be is very gradual on retail sales. And industrial production and consensus forecast is down 1% year on year, and last month in April is down 2.9%, and fixed asset asset investment is the consensus forecast up 6.1%, and in April 6.8%. So I think, yeah, that is pretty much about China. And then in Australia, we have some business conditions survey NAB business survey, and also the Westpac survey, and also we have the unemployment, the labor force survey. On labor force survey will be coming on Thursday, and expecting unemployment data will continue PD, may even make a new low, and so that is also something we should be watching. But the business conditions probably may worsen a bit in Australia. So yeah, I mean that's all for me.
Thank you,
And Charles, you have
Redmond.
anything to add?
Yeah,
Yeah,
I think
yeah, overrun. Sorry.
just to wrap up, I think we have these equity theme baskets in Saxo, and commodity remains a clear winner. Actually, all the companies are showing a high degree of immunity to the storms that we are seeing in the equity markets in general. So, all the themes that were more popular last year, like crypto and blockchain, e-commerce, or bubble stocks, they've seen year-to-date declines of more than 45%, which just kind of highlighting that importance of, that holding exposure towards the old economy, where this imbalance between the supply and demand will continue to push prices higher, and probably deliver a high level of profitability as well. So I think that's it. Yeah, we're running over time now. But of course, feel free to reach out to your RMs, arrange one-on-one with the strategy team as well, if you want to talk about all this and more in details. Thank you. Thank you, everyone, for dialing in, and have a great day, great week ahead.